morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonia Shenoy and Pavitra Pari. Good morning, girls. Looks like another quiet day, right? For our markets as we speak. Just down about 0.2, 0.1% on the benchmark indices. The mid-caps are struggling for the second day in a row. The mid-cap index is down close to about 0.5%. Right now, it's the FMCG stocks, the consumer names, the durables, which are powering for our markets. So Tata Consumer has moved to the high point of the day. ITC is clocking in gains close to about 1%. So that's the segment which is doing well for our markets. Hi.
Hi. In fact, I think towards the year end, as you head into the year end, the volumes also die down a little bit. And across the US markets, a lot of retailers have spoken about scaling down their, forecasts in terms of consumption, right? Whether it's Amazon, FedEx, latest is Target. So I guess there's a little bit of a tentative move, but our own markets have been so resilient. After hitting those 52-week highs, it's gotten a bit volatile, just a bit of patience before all-time highs. But there are global headwinds as well.
Oh, absolutely. So we're watching why for that. And by the way, if you take a look at the rest of Asia, you're seeing sharp cuts come through there. So something like the Hong Kong market is down 2.5%. You have Kospi down 1.5%. Shanghai is seeing cuts of 1%. So that's the kind of global setup also that we are in right now. For our own markets, the PSU Bank Index is once again the top gaining index. No crazy moves or anything, but it is still holding up amid the slow day of trade. Like Reema pointed out, the FMCG stocks are doing well. The listings from yesterday once again adding a little bit of steam. So you have BKG Foods, which is doing well. Global Health also doing well. And on the downside, you have a lot of these new listings, the Nykas, Paytms that we keep talking about. Those ones are seeing some sharp cuts today. So that's really what's going on with the market action. We'll come back to this. But first up, let's run you through everything that we have lined up for you on this show today. Profit taking in the Indian market owing to weak global cues. Metals, IT and auto stocks are hit, while PSU banks and infra stocks show some resilience. The market breadth is skewed in favor of declines. We will be joined by Jyotivardhan Jaipuria of Valentis Advisors to discuss the market fundamentals and the road ahead.
And we'll also be joined by the managements of Action Control Equipment, or ACE, and OnMobile Global to discuss the company's second quarter earnings and what they foresee for their businesses going forward.
Finally, Paytm, Shriram Transport, Suvain Life and our systems are buzzing in trade on the back of news flow. So all of the details coming up for you in just a bit.
Let's drill it down to individual stocks. Our entire team is joining in. The first up on our radar is Paytm. That's seeing some pressure after the big SoftBank block deal in the morning. In fact, right now, the stock is locked in a lower circuit of close to about 10%. And from its issue price of 2,150, the stock is down 75%. Its market cap has been eroded by more than 90,000 crore rupees. Vivek is joining in with the details of the block that took place in the morning. Vivek?
Well, that's right. Earlier today, we had indicated that there was a likely block deal in Paytm, and along expected lines, we saw a block deal, 4.5% equity, as per our sources, is what SoftBank has sold out of their total holding today. And we understand that the average price at which they had sold today is at close to 561 rupees a share. Now, what we understand is that SoftBank, that held almost 17.45% stake in the company at the end of the September quarter, was looking to exit, and they were looking at almost a 7% discount as far as the lower end of the price band is concerned. So from this particular deal, close to $200 million is what SoftBank has mopped up in today's trade. And interestingly, now there is a 60-day lock-in period. In this particular period, SoftBank cannot sell any further shares as far as Paytm is concerned.
Okay, thanks a lot for that. Well, Suvain Life is the other one. It's surging in trade after the company announced randomization of the first patent in trials for a dementia drug. Ekta joins in to simplify that for us. Ekta, over to you.
Thanks for that. Well, yes, definitely a positive which is coming for Suvain Life, which is basically an R&D arm. So they have a lot of molecules in their pipeline in order to assess whether or not they would be suitable to treat any kind of condition. So in terms of the molecule that we're talking about today, SUVN502, this particular molecule was earlier studied for Alzheimer's. It did fail the clinical trials, so the company did start studying it for dementia in Alzheimer's. So the piece of news is that they are they have announced the randomization of the first patient in the phase 3 global clinical trial for SUVN 502. So what they want to do is basically assess whether or not this particular molecule can eventually be used for dementia in Alzheimer's, and that's exactly what the phase 3 trial would do. The trial is multi-center, randomized, double-blind, placebo-controlled, and it is planned across 50 sites in North America as well as Europe, and will enroll approximately around 375 patients. But it is not something that we can expect in the near term. The top-line data is expected to be available only by early 2025. I also want to point out that it generally becomes a potential for a possible out-licensing opportunity, a strategic partner, probably for that particular molecule, if in case it does show potential. So maybe that's one of the key reasons why you're seeing Suven Life up around 10% in today's trading session. Suven Pharma should also probably come up for you, because remember, there was a lot of buzz of a possible stake sale in Suven Pharma, which would eventually be used to fund the R&D initiatives of Suven Life. So just keep that in mind as well.
All right, Ekta, thanks a lot for taking us through all of the details. So Suven Life is up around 9%, but another stock which is also doing well is Shriram Transport. This one is gaining in trade after the NCLT approves the amalgamation with the Shriram Group. So Abhishek is here to fill us in with all of the details. Abhishek?
Well, Pavitra, as you mentioned, NCLT has approved the scheme of amalgamation and arrangement between the Shriram Group. So this NCLT order was given to them as of 14th of November. So the company has fixed 30th November 2022 as the record date. This is to determine the fact that how many shares of Shriram Transport Finance will be given to the shareholders of Shriram City Union Finance as well as Shriram Capital. As per the merger terms, we already know that, for every 100 share of Shriram City Union Finance, shareholders will receive about 155 shares of Shriram Transport Finance. Back to you.
Okay, thank you very much for that. The other big stock in trade is R Systems. It's a small IT product engineering company, but it surged close to 17% in trade. The news is that Blackstone has said that they will acquire the promoter's 52% stake in the company, and for the balance 48% stake, 48.3% stake, they will launch a voluntary open offer to delist the company. The company, Blackstone, wants to get a 100% stake in the company, by which it can then delist the company. We caught up with the management, the current promoter of the company, Satinder Singh Rekhi, who is also the CEO, to understand the road ahead for the company. Why is it that they're selling, and why is it that amongst all the offers that they got to acquire this company, why did they select Blackstone? Listen in.
The rationale is that we have reached a point and we need a big partner who can take care of the company and take us to the next level of its growth and take care of its employees, customers, and partners. Blackstone is a great partner. They are very good, employee-friendly with their other portfolio companies, and that's why we wanted to partner with them. And the promoters will be involved. How it unfolds, we will know as we go along. I will certainly be a strategic advisor to them, and as we go along, the role will develop a little more. Blackstone has a lot of expertise, so that has to be utilized into the company.
As I said that, they will be acquiring a 52% stake from the promoters. They want to get the balance 48% stake, for which they are launching that, delisting offer. Now, but a lot of it depends on this one investor, Bhavuk Tripathi. He and the firms that he owns holds about a 37% stake in the company. So out of the 48% stake that, Blackstone wants to acquire, 37% is owned by one single investor. So, whether this delisting is successful at the base price that the company has selected, all boils down to what, Bhavuk Tripathi. Yeah, exactly. And, you remember in the case of Linde India, right? The first delisting base price was much lower, and they had to, keep revising it higher because they were unable to get the requisite shares to delist. And ultimately, Linde India is trading much, much higher than what the initial price is, right? And that's one of the reasons why our system right now is trading actually much higher than the delisting price, because I guess, the public shareholders are thinking that maybe we can try and get this, delisting price higher.
Okay, well, keep an eye out on our systems. One of the big movers in trade, the management telling us that it was about time that they get a large investor or large strategic investor on board. But now, of course, the deal has been done with Blackstone. Let's slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay with us.
Documents carefully.
Welcome back. It is indeed a very quiet day. The Nifty is down just about 40 odd points. The Bank Nifty is the one that's also down about 80 points, and mid-cap index not doing too much. So it gives us some time to ponder over some other asset classes. Manisha Gupta joins in, and today she's going to talk about sugar. We've seen the way sugar prices have moved up, but there's some more on exports. Manisha, over to you.
Thank you for that, Sonia. Well, yes, there is some positive news continuing in case of sugar as a sector, whether it's about the prices where the international markets are right now trading at a 5 and a 7 month highs when you look at the raw sugar and the white sugar prices there. So even now, as the trade has opened, we are holding above that $20 per pound mark, and that clearly has been supportive. If you look at this week itself, we have seen the sugar prices gain up by nearly 4.5% in the international markets, and this is clearly quite positive for the sugar mills who are looking at a strong export numbers there. The latest, clearly, the notification that came in last evening was that the government has now allowed sugar exports of around 14,500 tons to European Union and to US as well under the tariff rate quota. Of course, the quantum is lower, and this is something that the markets were in any case anticipating. But the fact being that we have a strong balance sheet when it comes to about availability of sugar in the country, and that would mean higher realizations when you look at the international markets there. So when you look at the overall Indian crop this time around, sugar production that is, it is estimated at 36.5 million tons. This is after it has been accounted for ethanol as well. This is higher than what we had in the last year. The carry forward stock of sugar from last year is at around 6 million tons. So that brings you to a total availability of around 42.5 million tons. Indian consumption is seen at 27.5 million tons, and the government already has allowed for an export of 6 million tons. With this 14,500 as well, the industry expects that by the end of January, when the government is reviewing the sugar crop and the season and the total availability in the country, there could be an agreement to export even more, because even after this balance sheet, India has a surplus of around 2,75,000 tons of excess sugar that perhaps could be seen for exporting reasons. And with the international markets doing so well, the expectation being that we could be looking at high realizations for the sugar mills.
All right, Manisha, thanks a lot for getting us all of the details on sugar. But with that, it's time for a short break on the show. When we return, we will be joined by the management of Action Construction Equipment to discuss the company's second quarter earnings. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18, and as promised, let's get you the first corporate conversation on the show. Action Construction Equipment, or ACE, delivered a strong second quarter. The company's actually reported its highest ever revenue for the quarter, but high raw material prices did weigh a little bit on the margin. So we will talk more about that. But to discuss the quarter gone by as well as the outlook for the years to come, we have Saurabh Agarwal, who is Executive Director of Action Construction Equipment, on the show now. Mr. Agarwal, good morning and thanks for joining us. This is Pavitra. So, I mean, it's been a very good quarter for you. Like I said, the highest ever revenue that you have seen in Q2 at almost 500 crores. Earlier, when we spoke, you said, you could see around 2,500 crores by FY 24. Do you think you could see higher than that now, considering that you've seen such solid growth in this quarter?
Yes, good morning. That definitely is a possibility. We had planned to attain about 2,500 crores by FY 24. So it seems that we might be able to exceed it. The quantum, I will know with time.
Okay, 2,500 crores by FY24. What do you think can lead to that? Is it the export markets? Because you have exposure to markets which are under a lot of pressure, whether it's Africa, some of the Middle Eastern regions. Are you expecting a recovery there, and what kind of growth do you see?
We've been thinking and planning of improving our export revenues, and then that's been happening. And this year again, we should be doing upwards of 100 crores. So that will definitely add to our, our target of reaching 2,500 crores. And obviously, it will be much more next year, coupled with some more defense business and obviously growth in our regular businesses, whether it's our crane division or material handling or construction equipment division within the country. So I think all in all put together, we are on the right track to attain what we had planned for.
So FY23 export revenue should be in excess of 100 crores, right?
Yes, definitely.
Okay. Could you just talk a bit about the segmental revenues? Your material handling equipment revenues declined by 5%. Even the agri equipment revenue growth was a bit subdued compared to the kind of growth rates that you've seen in the cranes business, for instance, at just about 6%. Could you give us the reason for these two segments and why the performance was a bit tepid?
See, in our material handling segment, there was some relocating, relayouting happening. So there was some production issues. So I'm sure we'll catch up. But if you look at half-yearly basis in both the segments, again, we have grown. And by about 44% in agri and about 6% in our material handling segment. So hopefully, we'll continue this growth. And by year end, we should be able to grow in both these segments again.
Okay. So production issues impacted the material handling equipment, which should recover in Q3. What is the growth rate for these two segments, agri equipment and material handling?
By end of the year, we are expecting that both these segments will grow upwards of about 15%.
Okay.
Okay, and what about the construction segment? Because I know last quarter, of course, you did see weakness on account of the BS4 norms, but how is that shaping up now?
It's shaping up pretty well, and hopefully in the construction equipment segment, we should be doing about 30-35% growth. And crane segment would be about 25%.
Okay, and for construction equipment, your margins are still, in low single digits, about 5%, 7%. Any scope to improve that?
I think we are on the verge of pleasantly surprising everybody.
Okay.
So hopefully Q3 and Q4 onwards, they should start to look much better. Maybe somewhere between 7-8%, maybe even higher.
So double-digit margins, perhaps?
Yeah, and then hopefully next year we should hit double digits even in the construction equipment sector.
Okay. You're saying in the press release, and I read, going forward, there has been some easing of commodity prices and supply chain pressure, and the company expects sequential improvement in gross margins if things stay as they are. How much do you think your gross margins could improve, and what's the number that you're targeting?
We've already seen some improvement in the last quarter as compared earlier. And in Q3, we should further see at least 1.5% improvement there. And going forward, I think it should be a total of about 2% by end of Q4.
Okay. You are the market leader in the mobile cranes and the tower crane segment, so you will be better placed to tell us about the kind of projects that are coming on board. Is it the pending projects that are seeing a renewal, or is fresh money being put on board? Is it largely by private? Are you seeing government orders as well? Just some color if you can throw for us.
I think everything is growing in that sense, especially led by metro construction, rail construction, bullet train construction, a lot of private things further happening in refineries and other projects, bigger projects. Even a lot of steel companies are on expansion mode, whether it is JSW and even Kalinganagar was just picked up at Tata. So things look good. Yes, in the last 1 or 2 quarters, definitely roads have slowed down a little, but that hardly contributes about 5-6% to our revenue. But I'm sure with time, even a road will pick up.
Okay. Mr. Agarwal, you had set up a new manufacturing facility for bigger cranes. Can you tell us what's happening with that? When should that start contributing?
Yes. See, we are also into the business of truck cranes and crawler cranes, which are bigger cranes, upwards of 40-50 tons capacity. So we are now intending to make even bigger cranes up to 160 tons, crawler cranes, etc. So we need a bigger facility. So we doing a capex of around 30-35 crores, setting up this factory, which will have a potential to do anywhere between about 300 crores to 400 crores of revenue.
Will this be operational?
We intend to make it operational by end of Q4 or early Q1 next year.
Okay, just one final question. Since you're saying that demand has gone up across the board, you know, private, government, steel, cement, etc., would you at any point look to raise your capex? Have you changed your capex plans either for this year or next?
In the current year, like I said, we are expanding our new facility, building a new facility for the bigger cranes. And I'm sure going forward in the next year, we will need to do capex to further increase our capacities of especially mobile cranes.
Okay, thank you very much, Saurabh, for joining in. That is saying that in the cranes business, the revenue growth will be 25%. In the construction equipment business, the growth rates will be 35%. They expect significant recovery to take place in the other two segments, material handling and agri segments, which are expected to see a growth of about 15%. And they're also guiding for gross margins to improve by nearly 200 basis points in the next 2 quarters by Q4 end from where it currently stands. The stock is a bit subdued right now, down close to about 0.5%. Let's invite Himanshu Gupta of Globe Capital now to quickly address the market technicals. Himanshu, another quiet day, but the mid-caps are showing signs of fatigue. They're selling off for the second consecutive day. Is this time to take money off the table? Is there a shot that you would recommend, or is this no trade?
Good morning. Well, if you see the broader markets, firstly addressing that part of the market, they have not been participating really for a while now. And it's not just the second day of trade. I think if you go back few days back also, there is a substantial differentiation that index is being taken out by a couple of handful of stocks. Rather, we have been seeing a clear signs of distribution in the broader markets. That's one thing about it. But if you talk about the index or the setup there, I think the way the FIs have been buying into the index futures and the setup, that is still suggesting that this is broadly a consolidation. And even if we talk about today's expiry, the volumes have been so slow, and despite a weaker Qs, every attempt to sell is being bought into, and at lower levels there is a continuous buying that's been coming in. So I would like to approach today's expiry as a sideways event as of now, where 18,300 on the Nifty is likely to offer a decent kind of support. And I think, again, one can buy around those levels, and a rebound towards 18,450, 18,500 cannot be ruled out in Nifty. Similarly, on Nifty Bank, I think 42,300 again offers a very strong support zone where one can expect a buying coming in, and 42,500, 42,550 kind of levels can be seen here. So as of now, it's basically a option writers day for the initial 2 hours are concerned. The volumes are also low, but I think on the dip, it makes sense again to enter longs in both the indices.
What about individual stocks? What are you looking at both on the buy as well as on the sell side?
Yeah, sure. So I'm going with the buy and sell recommendation, given the kind of sideways and the consolidation move it has been so far. So L&T, that's one stock that has actually given a very strong breakout in today's session. The derivative data is also positive, and the charts are suggesting that after a breakout, after a short consolidation, that stock is heading towards level of 2100. So L&T is a buy with a stop loss below 2025, targeting 2100. On the short side, I think SRF is one stock that actually has failed to show some strength even after the numbers. So that stock is weak, and one can initiate shorts in SRF for a target of 2300 followed by 2275, and a stop loss above 2360, 2360 can be placed in SRF.
Thank you very much for that. Get into a break. Up next, we'll discuss market fundamentals. Jyotivardhan Jaipuria, Valentis Advisors, joins us next. Welcome back. Let's talk about the market fundamentals, where we're headed. We're so obsessed about this one level, whether the markets are going to get to its all-time high levels. But even if we go touch there, are we going to, conquer significant ground over and above these levels, or are we going to touch there and perhaps retreat, because we have seen significant outperformance and valuations too are at a premium? To discuss all this, we're joined by Jyotivardhan Jaipuria, Valentis Advisors, and we're going to get his views on the markets as well as individual sectors and the way to approach your portfolio. Jyoti, thank you very much for that. That is the question, right? What from here on? Irrespective of whether we get to that all-time high levels, we hit that 18,600, that's just one level. What about the markets on a broader scale for the next 3 to 6 months?
Yeah, Rima. So if you see, like we are there or we are close to there, 1-2% here, there don't matter. But essentially, we've had a market which has been flat for the last 1 year, which on a relative context has been great. Like India has probably been a different planet because just given the way the world has fallen, India has done very, very well. I think the next 6 months again is going to be more driven by global factors than India, basically the Fed policy, how it goes. And second is how, the economy in the US pans out. So my guess is, the US market, Indian market, everybody will have two conflicting things. My view is inflation will come down, and so Fed will start slowing the rate increases. At the same time, there'll be enough signs that the US economy is probably slowing down, and there'll be worries on is it getting into a recession. So there'll be one positive, one negative. So probably, I think more flattish sort of markets ahead for the next few months also.
Okay, more flattish markets ahead for the next few months. But it is generally in these flat market periods, in these quiet periods where most of the money is made, right? Because in a sharply uptrending market, you generally can't catch good prices. So tell us, if one wants to invest now, where do you see both valuation as well as growth headroom?
Yeah, Sonia. So, like banks is something we've been talking about for quite some time. So I'll not repeat banks again. I think, one space which is looking very attractive to me from valuations, and they have not done well, all these segments where, commodity prices had gone up, and that's why input cost pressure was very high. At the same time, the demand environment remains strong. So what we are going to see now is last 2 quarters margins were weak for these segments. But as the commodity prices come down, margins will start reverting back to normal levels. At the same time, because the demand environment has been strong, you still have growth which continues in terms of volumes, in terms of top line growth. And with margins improving, you see good, profit growth coming through. Valuations for some of these have contracted, these shares have underperformed. So, if we get into some specific, like what are these sort of sectors, one would be, the tiles and ceramic sector, which had a massive price increases in terms of gas. So they've been starting to pass that on, and I think 2 quarters down the road, we'll probably see more normalized margins coming for them. The other is the whole wire and cable and that sort of segment where metal prices had gone up a lot. They were facing that pressure. But demand environment for all of these remains strong because the economy continues to be buoyant. So I think some of these segments are where investors should focus on things which have done badly over the last 2-3 quarters, but which will start gaining from the benefit of commodity prices coming down.
Okay, got that. Hi, Mr. Jaipuria. This is Pavitra. So, if you're talking about stocks being available at much cheaper prices, stocks which have corrected a lot, would you look at any of the IT names now? Or do you think because of what's going on in the US and because of this impending recession, we could see much steeper cuts here and it's still best avoided?
So, Pavitra, IT is something we've avoided for a long time because, our theme has been buy local and avoid all global stuff. Yeah. Because I think we'll have, probably like a recession in the US and a recession in Europe and UK. So to that extent, we feel more comfortable buying the domestic names. IT stocks have underperformed, so valuations are getting a little better. But even now at these valuations, I would say, given the uncertainty of the future outlook, I would still be like underweight these sectors.
Jyoti, earnings have seen a good upgrade cycle since, the troughs of COVID. Right, this quarter was pretty ho-hum, flattish, right? Some sectors did well, like banks. Some saw a bit of earnings cuts. How do you expect earnings to pan out? And in that context, do you think there is any arbitrage, any alpha that one can generate? That maybe banks will continue to outperform much higher than consensus expectations, and therefore you can still buy it from an earnings point of view.
Yeah, so Rima, I think like it will again be the same story. Buy the domestic names. So if you see this earnings season, I think it went quite well. It didn't go as badly as I thought it would. A lot of the things which dragged down the earnings were the global commodities, mainly basically all the steel stocks and the oil and gas companies. They're the ones which dragged down the earnings. Banks, like as you said, were the star performer. So basically without banks, the earnings would have been negative. With banks, earnings grew like at high single digit. So I think next few quarters, banks continue to do well. A lot of the other domestic names continue to do well. What will drag earnings is going to be all these global commodity stocks, like especially steel, and all these companies will struggle and they'll drag down earnings. So that's been the reason why we've been like, really pushing all the domestic names. We push the banks, we pushed the autos, and now we are seeing some of these sectors domestically which are in pain because of high commodity prices. They will start to perform now, and we've generally been avoiding the global plays.
Okay, avoiding the global plays. What about just a little more on autos, if you can help us understand, because it's a tale of two cities here, right? I mean, on one hand, companies like Tata Motors are seeing their CEOs quit, the businesses are under pressure, Europe is being hit. But on the other hand, local manufacturers, whether it's M&M, whether it's Maruti, are all doing quite well. So what do you do in pockets like this?
So, Sonia, we've been again doing exactly the same thing. Avoid stuff which is too dependent on global. Buy things which are very domestic oriented, because the domestic demand is strong, especially, the urban domestic demand is strong. If you see the rural domestic demand, which is, the two-wheelers, has not been as strong. So we've been playing the four-wheelers in India, the car names, and we've been playing the CV names, because those are the things where, we can see visible demand being good. We've generally avoided everything which is, very global. In fact, even amongst auto ancillaries, we've kept like a very strict watch on how much is the component they supply outside India, how much to Europe and all. And generally, we've been a little skeptical on stuff which is going outside India, because I think Europe may get hurt the most in this global slowdown, because, they are the ones bearing the whole brunt of the gas price increases and all the commodity price increases.
Okay, we will leave it at that. Jyoti, thanks for joining in and talking about the market as well as a whole host of sectors. Market, by the way, is really very quiet, ho-hum sort of a day today. But let's move on to other stories then. Sources say that the insurance regulator IRDAI's board meet is likely to be held this week itself, or next week rather. The expenses of the management limit and reinsurance regulation, amongst other norms, are expected to be discussed at the meeting. Yash joins in with exclusive details. Yash, over to you.
Well, that's correct, Sonia. So November 25th is the date when the board of the insurance regulator will be meeting, and the Insurance Advisory Committee has sort of recommended and proposed 11 amendments when it comes to the things and issues which will be going to the board of the insurance regulator for its consideration. I've picked out 4 important things which the Insurance Advisory Committee has proposed out of these 11 points. These 4 things which will go to Insurance Regulatory Board would be the regulations on expenses of management, the limit to be set there. The second one, open architecture for insurance companies in terms of distribution. Third one, reinsurance regulations. And the fourth one, registration of insurance companies. I'll quickly run you through these 4 points. Expenses of management limit. The insurance regulator is likely to set a limit in terms of expenses of management for both, for all 3, standalone health insurance, general insurance, as well as life insurance companies. Expenses of management is a sum total of the commission which an insurance company pays plus its direct expenses. So a limit on that is likely to be set by the insurance regulator. Open architecture for distribution. The insurance regulator is likely to discuss allowing banks to distribution tie-up with 9 life, 9 health and 9 general insurance companies. Currently, they are only allowed to tie up with 3 life, 3 general and 3 standalone health insurance companies. Reinsurance regulation. Importantly, and this could be a little negative for the listed company GICRE, the insurance regulator will consider removal of order of preference, which at this point of time favors GICRE in getting them reinsurance contracts. These regulations could put foreign reinsurance branches on par when it comes to the preference with GICRE. Fourth and the final one, registration of insurance companies. Here, a series of amendments could come when it comes to the relaxation of entry and lock-in period for private equity players into insurance companies. There could be amendments around threshold for promoter classification. That could be taken higher to 25% from the current 10%. Finally, amendments may specify lock-in period for investors of these insurance companies.
All right, Yash, thanks a lot for getting us all of the details. This board meet is on 25th, which is next Friday. So we will keep bringing you updates from that. But on that note, it's time for a short break. When we return, we will be joined by the management of Automobile Global to discuss the company's second quarter earnings.
Welcome back. The company which is on our radar right now is Automobile Global. This is a company which historically used to provide ringback tones, but since then it has evolved to provide a lot of games and quizzes on the mobile. The stock right now is down 2.5%. It came out with their Q2 numbers a while back. The revenues have been absolutely flat, just up 0.4% on a year-on-year basis. It's been impacted on account of Forex, as well as one-time customer interruption, which according to the company has been resolved. Profits too have just come in at close to about 60 lakh. We're now joined by Mr. Sanjay Baveja, the Managing Director and the Global CEO of the company. Thank you very much for joining in. This is Rima here. First, if you could give us a sense of how the second half of the year is going to be panning out, because this quarter was fairly tepid. There were certain one-offs, Forex, and then one-time customer interruption. Details about that and the outlook?
Yeah, good morning, Rima, and thank you for having me. So clearly, yes, H1 wasn't so great if you were to look at it, but like you mentioned, Forex was a major deterrent from our perspective. It really impacted us in a big way, specifically euro, because we had a lot of earnings in euro. But going forward, I think the bigger thing, which is most important, is how our new product, which is Challenges Arena, which is our, which we believe is really taking us to the next level, and Onmo, which is the other new product, which is the 5G enabled product, both in games, is going to take us. So if you were to look at the numbers, and we've grown pretty rapidly there. We've launched about 18 months ago, Challenges Arena. It's gone up 14x from the time we launched, 7x quarter on quarter, so clear year on year. So clearly, that's growing pretty rapidly. If you were to look at whether it's customer confirmations or the customers who are live, we've more than doubled in the last 7-8 months. So, for example, customer confirmations at the end of Q4 for last year were 26. We are now in October end, we were sitting at 55. Customers who were live were sitting at 16. And now we are sitting in October end at 33. So clearly, and that's a lead indicator of how our revenues are going to grow, specifically in the Challenges Arena, where we've seen rapid growth, even while we were absolutely flat as far as our Q2 revenue is concerned. Challenges Arena revenue grew by 20% quarter on quarter. And even in October, for example, we are already at a level of 30% over the average of Q2 for Challenges Arena. Clearly, this will lead our way. We believe that Challenges Arena, which is today at about 8% of our revenue, is going to be close to 15% of our revenue at around end of Q4. So that's really leading our growth. We've not grown over the last 2-3 years if you will look at our revenue numbers. But Challenges Arena, our new product, and Onmo, that's the other product that we've launched this year, will lead our revenue growth for the H2. And H2, we see really good growth coming in.
Just one clarification. Challengers Arena will contribute 15% to your revenues by Q4 end, right. And the current contribution is 7%, right?
8%.
8%. Okay, go ahead.
Okay, the net subscribers, right? I mean, have been at about 2.3 million. You refer to that as well. Tell us a little bit about going forward. What would the average run rate be in terms of net subscribers per quarter?
So we expect that by the end of this quarter itself, we expect about 2.9 million subscribers. So clearly, that's another, and that all depends on the number of new customers that join in. Now, as I said, we've already signed, got customer confirmations of 55 customers from October, and they will be launched over the next 2 quarters, and that will drive subscribers in a big way. While I'm not giving numbers beyond Q3 because we already projected Q3 and Q4. We don't want to talk about it, but clearly the growth numbers for we've already kind of achieved the numbers we thought we will do for the year in terms of number of customers. We will do obviously much better because we are still in November, and the subscriber base will follow the moment. And these are big customers that we are engaging now. If I were to give you a geographical spread, for example, we are about Middle East and Africa is a big chunk for us, about 42%. Asia, the rest of Asia is about 34%. And then Europe, 10%, and LATAM, which is another big increase happening, is 14%. So clearly, as we engage more and more with new customers across the globe, we will see rapid growth in our overall subscriber base, and that will drive revenue clearly.
All right, got that. Good morning, Mr. Baveja. This is Pavitra. So like you were saying, the challenges arena is likely to grow very well. You also see contribution from that at 15% by Q4. Can you tell us how Onmo is growing? Because you are sounding positive on that part as well. What is the run rate that you expect there, and what is the kind of contribution that we can see go up to from current levels for Onmo?
So Onmo as a product we've just launched.
Yeah.
I mean, it's the B2B part, and it started to grow, although it kind of doubled quarter on quarter, but that's like very small numbers. We expect it to follow what happened in Challenges Arena last year would happen in Onmo this year. So we expect it to grow up to about 3-4% of our revenue, but clearly the real growth we should see Onmo in next year. Next year is going to be really big. We are live with about 4 customers there. We've got customer confirmations from 18. So we expect, again, as they go live over the next 2 quarters, we'll see our next year will be a huge growth area from both Challenges Arena, which will have many, many more customers, and Onmo, which we expect to really take up from there. So next year will be our year for Onmo, the real big growth from Onmo. And of course, Challenges Arena will continue the trend that it has shown.
To understand the business, so Challenges Arena, we know, focuses on quizzes and certain theme-based challenges. What exactly is Onmo, and under which segment does it come under? Because you classify your revenues as videos, which is 40%, tones is 37%, and I think you've got some legacy contests and information, which is, yes.
Yeah. Actually, it's the contest that we, from a legacy contest perspective, is where we started thought on Challenges Arena, which is a gaming product. So it is quizzes, trivia quizzes, but we put in games into that, and that's what Challenges Arena is all about. And we've seen a lot of, and we put also fantasy games in it. We put some social elements in it. But Onmo, and it's a 4G enablement product. Really, it's at that level. Whereas Onmo is our 5G enabled. It's like, if I may call it, a TikTok of gaming, where we are putting in hundreds of games where we'll have thousands of movements. So we noticed that 85% of the people don't play games for more than 10 minutes in a day. And it's to that area that we are looking at. And we are saying most of our game moments are going to be between 30 seconds to 3 minutes. And we want people from our AI perspective to focus on portion of the games which they want. Somebody would like a very cryptic part, somebody would like a slightly lesser part. So we want people to focus only on that part of the game which they can play, and this will be a direct streaming. So Onmo is a 5G enabled gaming product, and that's why I said next year will be a bigger year for 5G, because all the 5G players, while they're putting up a lot of investment into 5G, the revenue cases are not there as much. So we are enabling that. We're probably one of the first ones to go off the block in terms of enabling the 5G gaming product. And that's Onmo, which is our next level of product. So from a 4G perspective, it's Challenges Arena. And from a 5G perspective, it's Onmo, which is going to be the next year, the real growth engine for us for next year.
All right, Mr. Baveja, we got that. Thank you very much for joining us. We're going to leave it there today. That is the management of OnMobile Global. They are saying that Challenges Arena, that part of their business is doing very well. The contribution from that is also expected to go up, and Onmo could probably see a very good year next year. That is on OnMobile. The stock hasn't done much actually. This year it's down around 4%, but this month it's seen a cut of around 12%. We're going to get into a short break now. You don't go anywhere. There's lots more market action in just a bit. Welcome back. You're still tuned into Trading Hour. For the market, we're still seeing around a 40-point cut on the index. So 18,366 is where we're at. We have moved off the day's low, but it's still around a 40-point cut. The banks are faring a shade better. So those ones are looking a lot better because the PSU bank index is really helping the market, but still around a 70-point cut on the Nifty bank is what we're seeing. It is some of the FMCG stocks which are holding up today. So some of the larger names, which are managing to trade in the green, the likes of Tata Consumer, HUL, which are managing to hold up. But that's what's happening with the market action. We're going to wind down on that note, but you guys stay tuned. Half-Time Report comes up next.